just a normal working class lad.
Multi-million pounds worth of assets.
25 years has really taught me a lot. I've got a golden rule.
So I'm super excited to have Sonny join us on the channel today. Sonny has been able to go from zero to multi-million pounds worth of assets over the last 20 years. And he's kindly going to share some insights to help us along the way. Sonny's portfolio is ranging from various assets such as property, equities, bonds, cryptocurrency, and also cash. So Sonny, it'd be really good to hear a bit about yourself, how you've built your assets over the last 20, 30 years, and what's made you be so successful.
You know, my journey hasn't really been that special. We'll talk about it over the next sort of 10, 15 minutes, but it's a demonstration of what just applying yourself, you know, getting a little bit of financial education and literacy and just common sense can do for you. So really just by way of introduction, my background is just a normal working class lad, and I just got interested in property when I was about sort of 25 years old at that sort of time, which for me was sort of the late 90s really, giving my age away now. And I didn't know anything much about property, which I guess may or may not be common with some of your viewers. But, you know, 25 years has really taught me a lot around trial and error. But of course, as you go through your journey, you become more aware, get a lot of learnings, and you become a little bit more sophisticated. So I started with my first property in 1997. It was just a 2 up, 2 down. I bought that, I rented it out. Back in those days, believe it or not, the average interest rate was about 7 or 8%.
Wow.
And so I bought the property. I did some basic maths to make sure that the rental covered the mortgage, left me with say £100. At that time, I didn't factor in anything for maintenance, etc. Again, my naivety. I didn't even factor in that I'd have to pay tax on it. And that just got me in the ladder and I got going really, Dean. And it's just been a journey from there really over the last 25 years where I've bought something, sat on it. I've got a golden rule, which is never sell. That's just worked for me. And I've found that if you can ride out the storms, the ups and downs, and never sell, eventually you will be able to take that asset, maybe take some money out of it if you're lucky enough to get some appreciation. And you can do certain things to it, which we'll talk about in a minute, to try and force that appreciation. But it's just a rinse and repeat. Hold an asset, never sell, make sure you get some cash flow out of it, and then wait for the asset price to go up, take some more money out, buy your next one. And that's really what I've been doing. And then I kind of got to the point, I think after about 10 or 15 years, where I realized that I was probably going a little bit too all in property. And, then I started educating myself around the benefits of diversification.
Yeah, very important.
There's something called asset allocation.
Yeah.
Okay. So, and what we mean by that is there are various different asset classes out there which have different risk profiles. So I started researching some of those, Dean. So I said, okay, I've learned a little bit about property and how property works and got some scars, which we could probably spend 3 hours talking about the lessons long. Maybe we'll do that on our next episode. But I thought, I don't know much about all the other asset classes out there, the alternative asset classes, which are primarily equities, the stock market, bonds, which are government bonds or corporate bonds. Cash is an asset class, guys. And then you've got physical commodities such as gold, etc. And obviously over the last few years, we've seen the emergence of, digital currencies, crypto, Bitcoin. Everyone knows about Bitcoin. And then I just started educating myself on some of those alternative investments. And then about, I think 10 years ago, my journey started in not only property, but financially literate on understanding the basic differences between an individual stock versus an index fund.
Yeah.
How do they work versus an exchange traded fund, corporate bond versus government bond, etc. But this journey of learning never stops, Dean. I mean, I'm now 52 years old and 27 years of doing this, and I'm still learning every day because it's such a fascinating topic around learning about financial education. I mean, I'm not a financial advisor, so I'm not here to give anyone financial advice, but this is just share my learning, which is the more you can educate yourself and learn about these things, the more you can have an advantage over, I guess, the average person that doesn't take the time to invest in their knowledge.
Exactly. And I think that's a really important thing. And that's why I've built this channel, is to help people. And I have quite a good understanding of equities, ETFs, etc. But one thing that I'm not as au fait with is property. So this is where your mentoring and coaching really helps me, and it can also help our audience. So thank you. I think one of the next questions that would be so good to understand, and you've touched upon it a bit, is how are you able to build such an impressive portfolio of assets that you have? And what's your current priorities when it comes to it as well in terms of the asset allocation?
If I had to just summarize it, I think you have to start by understanding what phase of your life you're in.
Yeah.
Okay. And it's because I think, I'm going to keep it simple. I think there's really only 3 stages, I think. The first is just what I call education stage.
Yeah.
And learning stage. I don't recommend anyone invests even a single pound of their money or a single dollar, until they actually understand what they're investing in to some extent. Okay. So that's the learning phase. So you might spend a couple of years just learning. And then really there's only 2 phases, which is the accumulation phase.
Yeah.
So if you have to draw a graph, you accumulate. As I always say to my friends, and I've said to you as well, there's no point accumulating for the sake of accumulating until the day you drop dead.
Yeah.
Right. Because the question is, what are you accumulating for? You're not accumulating to be the richest man in the graveyard, are you?
No.
So you're actually accumulating to hit a peak and then de-accumulate, right? Actually enjoy the money and spend the money. So how have I done it? I first decided that I was going to spend a few years learning. I got to my late 20s and then I hit the accumulation stage. And the simple recipe was a few things. And really, I put in 3 ingredients.
Yeah.
1, to generate a high income skill.
Yeah.
Right. And develop a high income skill, because I'm not going to sugarcoat it. Without disposable income, it's very hard to buy properties or any asset if you haven't got any money.
Definitely. Yeah.
Right. So the only thing I'd say to your viewers is don't believe all the hype around no money down and get rich with 0 money and all this stuff. It hasn't really worked for me, and I don't know how that stuff works. Right. But I am a slow and steady guy. So 3 ingredients: either develop a high income skill.
Yeah.
So, I became a chartered accountant. I joined an industry which pays relatively well. So that's the first thing I did. Haven't got the opportunity to do something like that, a professional career, then really the only other way to do it is to try and generate a business. So that's the first ingredient. And then the second ingredient is you then have to really understand how your P&L works, your income and your expenses. Okay. And try and maximize how much money you've got left over at the end of every month. And that, as I said, is a combination of maximizing your income through the high income skill or a business, but really laser-like focus on your cost base, cut out frivolous expenses. And there's a key word that I use, I even use it with my kids: delayed gratification. Yeah. Right. I'm sorry, guys, but you either want to save money and buy assets, or, you want to go and spend the money on consumables and be a consumer and go and buy the latest BMW M3 or whatever you want to buy. Right. But then you're not going to build assets. You'll have a great car and all your friends will think you're really rich, but you won't build assets. And then the third ingredient is, if you're working hard yourself, Dean, and you're getting up every morning to work hard, I have a rule. If I'm working hard, every dollar that I've saved or every pound that I save has to be invested in something, an asset that actually works twice as hard as I do. Yeah. Because if I'm working hard every day, my pals have to be working equally as hard. Yeah. Yeah. Great. So I don't believe in lazy pounds. Let me give you the quick definition of that. Lazy pounds is where you just keep your money in a bank account because, they're lazy and they're earning 2% interest, where inflation's running at 3, 4, 5% because, that pal's losing you wealth. Yeah. That's it, really. Generate high income, minimize costs, delay gratification, and get educated and invest in assets. When you think about it, Dean, it's actually very simple.
Agreed. Right. And then I guess one thing that probably be good, Sonny, to understand is obviously you touched on it earlier, you've been very successful, but you must have made some mistakes along the way. What would be the biggest mistake you've made and something that our viewers should watch out for?
The biggest mistakes that I've made is when I first got into property, and this is where I think this channel will help in terms of education, is that I didn't have a mentor or anything like that. So the biggest mistake people make is not accounting for the full costs of running a property or the portfolio, right? And there's a lot of hidden costs, guys. So, people normally say, okay, this is the rent I'm going to get, and then, this is my mortgage, and that's about it. So the mistakes I was making is I didn't realize at some point I'd have to hire a managing agent because I had a full-time job and I just couldn't deal with it. So I had to hire somebody and they would take anywhere from 6 to 10% of my rental. Okay. The biggest thing is, depending on how good your tenants are, sometimes tenants move out. It might take you a couple of months to find new tenants. Yeah. So trying to budget for void periods. I lived in a, blue sky world where I never thought anything would go wrong. The boiler would never break. But of course, inevitably it does.
Yeah.
And all of a sudden I haven't got a reserve fund for that. So in summary, the biggest mistake I made was, and I have to say this in the account, is not properly costing out right my projects. You know, guys, I know it sounds boring, but the numbers don't lie and you have to get the numbers right. And property will hurt you if you haven't got your numbers worked out. That hit me on a couple of properties where I hadn't costed for the full costs. And when those costs hit, I was actually in negative cash flow on a couple of them. I was actually paying money out of my own pocket. Yeah. So that's one of the first learnings. The other learnings were, the other big learning is, and I don't want anyone to take this the wrong way, I was too trusting. So I delegated all of the responsibility to my managing agent, and I relied on them to make sure that the gas certificates were up to date, because the property world is covered in legislation, gas, electric, safety, and I just assumed they were doing it. Right. But I forgot to realize that they're my agent. The ultimate lawful responsibility is still with me, D. So, you know, keep on top of them. I'm not saying don't trust them, but make sure they're doing what you're paying them to do. And that was the other one. And the third thing was procrastination. So not keeping up, because, you know, the biggest expense you're going to have in property, guys, is unless you're cash rich, you're going to have to take mortgages. Right. And sometimes, you know, I wasn't getting the best deal on the market because I wasn't on top of it. I was just going with a recommended broker who was affiliated to a certain product, and he'd make a better fee on that. And I wasn't tied into the best interest rate. And that probably cost me thousands. And why? Because I didn't want to pay the £200 fee to the independent broker.
So I think we've got time for one more question. So I think quite a pertinent point now. So obviously we've got a new Labour government. There are some fears out there that the market may not be as good as it once was in property. You and I have talked about this before. We think that's a bit of a moot point and property is always going to do well. But do you think someone like me getting into property in the next year or two, if I follow good rules and I invest wisely, I'll be able to do as well as, say, someone that's such as yourself?
Yeah, look, I think that's a really, really interesting question. Look, we've got a new government, and look, I always say you cannot ultimately plan for legislation which is unknown, right? So look, I think regardless of what government's in power, I'm a firm believer that, you know, the laws of basic economics and supply and demand still apply. Okay. So let's think about this for a second. So to answer your question directly, I think we still have huge demand. I mean, you only need to go, and where's the demand coming from? It's coming from two main factors, or three main factors. One, there's just a lack of supply of land. Right. We live in a small island, especially London and Greater London, which is where I invest. So I'm not talking about the whole of the UK. So I think that's the first factor. The second factor is you look at where net immigration is. I know we've had all rights and stuff, but, you know, we've got increased net immigration and these people need somewhere to live, right? So demand keeps going up, supply is restricted with the amount of land. And then the third stat you need to look at is the house building targets that have come out, whatever the number was. But they've never done that historically over the last 15 years, right? So the economics of supply and demand naturally point to there always being demand for rentals. And then you put the wrapper around that, which is the affordability. People just either can't afford the deposit to buy a house, and even if they had the deposit, they can't afford the multiples for the mortgage. So as a landlord, you're providing a service of value to a whole community out there that needs landlords. Yes, I think it's still viable, but I think now you've got to be even more prudent. You've got to be even more conservative on your numbers. And coming full circle of conversation, now I think there's still pockets of opportunity. Whereas 10 years ago, you could probably buy anything with a blindfold and you would make money on it within reason. Now you've got to be very particular about your location, research the demographics, understand the rentals in that area, understand the type of people in that area. And I think it's still viable, Dean. But you got to do your homework.
And I think when there's fear, uncertainty and doubt in the market, that's always a good way to buy. So there's going to be opportunity as other landlords are selling up. If you get the right property, you can do well.
Yes, I agree with that. I think you're either going to be, if you're in the market already, I think you're going to fall into one or two camps. You're either going to be a landlord that says too much legislation now, too much shift of power to the tenant, I'm selling up and I'm done. Or you're going to be contrarian in your thought, which is probably my camp, which is landlords leaving the market means less supply. right? More demand. And that means that ultimately that means more profitability on rent, if you think of it as a business. But what you have to then also consider is that actually with the cost of living crisis and the credit crisis, you've just got to be more picky around the quality of your tenants.
Yeah.
Right? Because there's more propensity for credit default.
Yeah.
Yeah. And people not being able to pay. So you got to be very picky and choosy references and just vet your clients very thoroughly.
That's great.
Yeah.
No, thanks, Sonny. It's been absolutely fantastic to talk to you today. I really appreciate you coming on, giving me guidance and also to our audience as well. So thank you very much.